Okay, so let's talk about one example of how exactly we use the balance sheet variables to predict a price, like we did for income statement. And I told you guys it's theory-based. We use theory-based ways to do that. And so let me talk about the theory first, and then you can see how we test the theory, okay? You guys remember before the break, we said we have two approaches. One is theory-based approach to analyze the data. Another one is machine learning-based approach to analyze data. We focus on, let's do the theory-based for most of the analytics. We'll also talk about the machine learning-based. So since it's theory-based, let's look at what theory we have. What theory we have to analyze the balance sheet. So the theory what we have here is there's an agency problem between managers and the investors. You guys all understand that investors owns the company. Investors own the company, but managers run the company. So there's a separation between the control and ownership. So it's like so it's like your friend is running, you're doing your homework. Basically, the grade is yours. Your friend is doing homework for you. He's doing the homework, or she or he is doing the homework, but the grade belongs to you. So you have more incentive for higher grade, but actually you're not a person doing the homework. So this is like typical agency problem. So what's the problem here? That we can use the balance sheet information to predict the stock price. The theory we have is managers, they intend to empire building a company in order to get more control. So for example, a company, a manager, if I'm a CEO of a company, I want to hire more people so I can control more people. I want to buy more houses, assets, department. I want to expanding the company because originally I only can control 100 people, but I can control 10,000 people. I want more control of the resource. And why I want to do that? Because the money is not mine. I'm using shareholders' money. I'm using borrowers' money to expanding my source, to expanding my resource. So there's an agency problem here that that the managers using the house money. Using the house money to expanding the firm for their own controls, and that's the problem. And that's the problem. And another problem is investors do not know what the manager is actually what they're doing. Like taking an example back, you have your friends doing homework. If you can really do the homework, why you have your friends doing it? The reason you have your friends doing homework because you don't know how to do the homework. But can you really close monitor your friends? Really, is he or she really doing the homework right or wrong? You have that information asymmetric. You have the information asymmetric. So that's the problem here. The problem is the following. So investors give the money to managers, and the managers use other people's money to expanding their own resources. This is problem one. The problem two, the investors cannot exactly evaluate the manager's action because the information asymmetric. They cannot exactly manage the manager's action. They cannot evaluate the manager did it wrong or right or wrong. And also the managers have the incentive to expanding the firm for their own purpose, not for the shareholders' interests. So all these together, what we found is if a firm have extreme asset growth, the firm will experience negative return in the future. So that's what we have experienced when we analyze the data. Let me repeat it one more time. So what do we from the theory is what? From theory, what we have is if a firm has extreme asset growth, I put extreme here because just a little bit growth is fine. If a firm has extreme asset growth, and the firm will experience future negative performance, sales, and also have future negative returns. So that's the that's the Cooper have done for the balance sheet analysis. So the bottom line, this is, I said this is theory driven, right? Theory driven. So let's just putting down a theory here. What's the theory? The theory is, if a firm experiences extreme asset growth, that means the manager is doing empire building. That means the manager is using shareholders' money to expanding for his own control, and the firm has negative sales and performance and stock returns in the future. That's the theory we have, and we are going to test it. How we test it? So you can see that this is the table you guys see from the reading. What we have here is what we have here is the assets here. The assets here is the asset growth, and the asset growth. What does this variable mean? This variable mean here is, if a firm have extreme asset growth, what's the dependent variable here? Dependent variable here is the stock return of next year. So basically, the idea telling you is, if a firm has extreme asset growth, the firm will experience negative stock returns in the future, in the next year. And so we have the theory, we have the test. We have the theory of test. The theory is, when they may do empire building, they may have future negative returns and stock price. And the test is, we did show that we did not meet Cooper and the Fairfield. They did show that the asset growth predict future negative sales and predict future negative returns, and everything is negative here. So this is what one simple way. This is one simple way you can use the balance sheet to predict the future stock price. And we have a theory as a backup, right? The theory is here because the managers using the house money to bet the game, and so that's why the asset growth here predict the future negative stock returns. And then so what do we do? What can we? So this is the story I want you you guys can think about your own. How can we improve on that trading strategy? We already know that high asset growth will predict future negative returns. We know that, but you cannot just every time you follow other people, right? You have to create your own strategy. How do you create your own strategy from this example? I just want you to know how the literature evolves. So here is the very interesting decomposition of asset growth. So asset growth can be decomposed into different components. The asset growth, you can, when the company is growing their assets, there are different ways they can grow their assets. The first one is they can borrow money from investors. They can get money from investors and the bank and the bond market to grow their assets. That's one way. The other way is they can borrow money from vendors, suppliers, to grow their assets. So there's two different ways to grow their assets. So that's why we have here, it's the operating net operating assets or the operating liabilities. So we have two different ways to grow the assets. Let me explain in more details. What does that mean? So let's say if just take a company, Coca-Cola, then let's use another example. Let's say if Amazon purchased a lot of warehouse. You guys know the Amazon, they have a distribution center. They have a lot of warehouse. They have the auto robots deliver the shipment to the neighborhood. So let's say I'm Amazon. I want to purchase the building as my warehouse, but I cannot make a payment for the building once. I maybe pay the building for 10 years. In the 10 years, I have a 10 years payment to finish pay up for the building. So in that case, let's say the building is $10 million. It's $10 million each year. Amazon pay $1 million to the seller of the building for the payments. So in that case, the first year Amazon paid $1 million, and Amazon will pay another $9 million to the seller of the buildings. That $9 billion is actually the money the seller of the building lend to the Amazon. Does it make sense? Does it make sense? So basically, when Amazon didn't pay the building in a full amount, when Amazon spent 10 years to pay the payments for the building, the later payment is actually, that's the liability to Amazon. That's the money the building sellers lend to Amazon. So in the case I just explained, if the building is $10 million, when Amazon paid the first year $1 million, the rest of $9 million are actually the money the Amazon, the building sellers lend to Amazon. So this is one way Amazon can grow, right? Amazon can grow by purchase a lot of building, but can only make first payments. The future payments will be the liability to Amazon, will be the money Amazon borrowed from the sellers. So there's another way Amazon can grow. Amazon can do what? Amazon can borrow money from bank and then purchase the building in the full amount. The Amazon can and issue more stocks in the stock market and use the cash from the stock market to purchase the building in the full amount. And Amazon also can issue bond and use the bond to purchase the building in the full amount. So you see that. So you see the two options I was talking about. So Amazon has the two options to purchase the building. Either Amazon can get the cash from the stock market, bank loan, or bond market to purchase the building in the full amount. That's one way, right? Another way is the Amazon can actually make installment payments, like 10 payments, and the rest of payments will be liability to Amazon, money lent from the sellers. So what I'm trying to say here is, where is the money from may matters a lot to analyze the balance sheet. Why is that? Why is that? The theory that we said this is a theory. We want to talk about a theory. The theory is the previous study, we only talking about the managers. They want to expand in the firm. They want to do something bad. That's the original theory. But what we want to add here is, it depends. It depends where is the money from. If the expansion is from the money from the sellers, from the suppliers, this may be good expansion, good growth. But if the money is from the stock market or bond market or bank loan, it may be bad expense, like we growth, what we did before. So that's the theory we want to propose here. What's the theory we want to propose here? So why we do have that theory? The reason is the following. The reason is the following. So sometimes you may be wondering, where's the theory from? The theory, you need to talk to industry people. So when you talk to a lot of vendors, suppliers, you will immediately realize there's a lot of information like you cannot get from reading the textbook or the papers. So I personally get a lot of ideas and theory from the industry people. I talk to them, I exchange idea with them, and I get something very interesting, and I use data to test it. This is something you can do as well. You can talk to, that's why I have industry speakers come in. They may have give you some ideas, but you have to test it. You have to data test it. You test that is correct or not correct. So this is the idea I got from talking from the industry experts. So what they told me is, let's say the building sellers. The building sellers, they will not lend money to Amazon if they believe Amazon is just abuse the cash. They just abuse the growth of the firm, because the building vendors, they cannot afford Amazon to not pay them back. So when the building vendors, when the building sellers trying to lend the money to Amazon, they will be extremely careful. So versus bank has a huge loan portfolio. If Amazon cannot pay back, it's fine. They can wait. They can wait for late payments. Bank has the flexibility to afford the late payments, but most of the commercial, for most of the building or the vendors or suppliers, they cannot afford taking later payments, otherwise they will go bankrupt. So so that's the insights I got from a lot of industry experts. They said when the suppliers and the vendors, when they trying to financing their buyers, they will be extremely careful because they cannot afford later payments. That's the reason one. That's the reason one vendor, supplier, and the vendor financing and the supplier financing, they have more careful review process than banks and other firms. That's the reason one. The reason two is when the vendors and the suppliers evaluate Amazon, the evaluation is in a very natural process, versus bank and the investors, they trying to evaluate the Amazon. It's more of a format or more of a presentation of good information. So let me give you an example. So the vendors and Amazon, they have a natural business transaction. They can know each other well in a very natural way. And so they know each other from the very natural business transaction. So all the information are authentic, are truth. Versus bank and investors, when they trying to investigate Amazon trying to present only the good side of the information to this bank, to these investors. So there's a lot of information hidden there, and this is a risk for the creditors. There's a metaphor we can use here. Let's say if I borrow money from my friends and borrow money from my bank, which one would be easier? I know this is sometimes is easy, not difficult to say, but normally, why borrowing from my friends signal I'm doing a good thing? Borrowing from bank signal I'm not doing good thing. So let's say you are my friends, and let me pick up a name here. So let's say Jintai. Jintai is my friend, right? I said, hey Jintai, can you lend me some money? I'm going to do something good. So since you are my friends, we have a natural business transaction together. If I do something bad, you will tell me, say, hey professor, I'm sorry. I mean, I cannot afford that. And you are doing something I don't understand. You are doing something which I don't think will work. Can you just forget about the idea? So because we know each other from natural transaction, and so he can evaluate my how I spend the money in a very natural way, in a very transparent way. Let's take about another scenario. I borrow money from bank. I ask a bank manager. I say, I want to borrow some money. So how am I going to present myself to the bank manager? I'm going to present all the good things. Oh, this is my income. I have a house. I have a nice car. I present all the nice information to the bank managers. And I can also at the same time I hide all the information I'm concerned about. So in that case, so who get better information from my future project? Is that my friend Jintai or is the bank manager? In most of the time, it will be Jintai because he has more of a transparent way to evaluate my future project. Versus bank manager, there's a lot of hidden information there. So that's the story. That's the theory I want to share with you guys. So the story, what we have here is, we want to say that the old analytics of the balance sheet saying that as long as the manager has extreme growth, the manager is doing something bad for the investors. Everything is bad. So what we want to say here is, wait. Hold a moment. We have to. There must be some good managers. There's some bad managers, but good managers. We cannot just one size fits all. We cannot just say everybody is bad, all growth is bad. We have to see who are the good managers, who are the bad managers. And the way we're trying to distinct them together is by looking at where's the money from. If the manager's expansion plan is from the vendor's financing, is suppliers financing, and then we say this is a good manager growth. If the manager's growth borrowed from the bank stocks and the bond market, and we found this is the bad growth we are talking about. So here is that's the twist. That's the twist we have trying to add more to the balance sheet analytics. That's the idea I want you guys always think about on your own. When you heard the first idea, can you get the second idea? When you heard this second idea, can you get your own idea? Like I said, you guys are finance major. Your parents must expect you guys to provide some investment tips for them, right? So how you guys, you have to come up with this kind of idea by talking to industry people, by reading the material I gave you guys, by doing some data analytics. This is the homework you have to do behind. So just to summarize what we have here is, we cannot say all the managers who are doing growth, extreme growth, are bad. We cannot say that. We must to identify some managers who are doing a good job for growing the firm, who are doing a bad job for growing the firm. For those who are doing a good job, we look at where is the money from. If the money from suppliers, they are doing good job growing the firm. If not, they are doing bad job from the firm. And the theory is what as I explained, because the suppliers, they know more about the managers. They can evaluate the future expansion plan of the managers. If the manager are doing something bad, terrible, suppliers will not willing to lend the money to the managers. If the suppliers are willing to lend the money to the managers, that's a signal. That's a signal to the market. If I can borrow money from all of you guys, then that's a good signal. That means you guys admit I'm doing something good, right? I'm doing something good. So this is the theory behind that. We want to differentiate good managers from bad managers in terms of growing the firm. And then this is the theory. And then what's next? You have to test it. Okay, you have to test it. Like I said, you cannot just say, oh, this is theory, done. And for every single trading strategy, you have to test them rigorously. This is about money, you know, and this is about money. It's about your money and the investors' money. So you have to be very careful about all these theories. You cannot just say, oh, makes sense. Yeah, professor, what you said makes sense. That's you guys true. Let's do it. Let's put the money in. You have to test it. You have to do a serious testing. You have to calculate abnormal return. You have to calculate risk. You have to do the rolling regressions. You have to do the pharma MacBath regressions. You have to test it. Okay, how exactly we can test it? So so we have to let's explain the way we can test the theory. Yeah, when you guys review the slides, you can see like most of the contents I put here. So for example, the suppliers know the Amazon better because they have a natural transaction. They can have side visits, and also they cannot afford late payments. All these summaries I have put on the slides. So okay, so how exactly we can test it? How exactly we should test it? The way we test it, I have two steps. Okay, the first step is you have to calculate the growth that is financed by the suppliers, and you have to calculate the growth that is financed by the shareholders, bank loan, and bond investors. So number one is you have to construct the growth, the different growth in order to do the testing, right? Do the testing, because the theory is what? The theory here is original theory is all the growth is bad. As long as the growth is bad. What we want to tell is if the growth is financed by suppliers, good growth. If growth is financed by the other is bad growth. So you have to calculate this measure. You have to calculate this measure. So in the reading I gave you guys, I give you the details, the formula, how to calculate that. The calculation is straightforward. It's straightforward. Basically, the idea is we have 250 variables out there. You use the 250 variables, you do the combination of the theory, you can always calculate what you want. So you use the variables I gave you guys, you can calculate the growth that is financed by suppliers. You can also calculate the growth that is financed by investors, bank, and shareholders. So you can separate the two growths from each other by using the 200 variables I just showed you guys moments ago. That's the idea of data analytics. You can use the variable I gave to you to calculate these useful measures, the signals. And then once you calculate these variables, you have to test. You have to test the return, whether it has the future stock returns in terms of can it really predict the future stock returns or not. That's something you need to test. So so this is the number one. Step one is to calculate the measure. Step two is to using what we discussed last video to test whether you can predict the future stock price. And so here let me show. Let's do step by step. Let's do step by step. Let's do the let's consider two measures first. The first measure is what? The first measure is the total asset growth. The second measure is the NOA growth. Let me just give you an idea what the two growths mean. The total asset growth is the growth financed by everything. That's the growth financed by, as long as it's the growth, it doesn't matter where's the money from. The total asset growth is the growth of the firm financed by everyone. That's the total asset growth. The second growth is what? It's NOA growth, net operating assets. What does net operating asset growth mean? That's the firm growth financed by shareholders, bank loan, and bond market. Okay, bond market. So these are the two growth measures. These are the two. So in the paper I gave you guys, I give you very detailed way to calculate this growth. You can look at the formula. You can look at formula in the paper to understand that. But I want to give you guys the idea of what does that stand for. Let me repeat it one more time since it's an important concept. The total asset growth, that means the growth financed by everybody. The NOA growth, that's the growth financed by shareholders, bond, and bank loans. So looking at these two types of growth, what idea you can get? Which one will predict future? Which one will be more associated with future negative returns? Is that NOA growth or is total asset growth? I think you guys have the answer, right? You guys have the answer. We think the NOA growth will be associated with future negative returns more than total asset growth. The reason is because the NOA growth is financed by those shareholders bond market, so it's purely bad growth. Versus total asset growth, it contains good growth and bad growth. I just want to make the big picture clear to you. The total asset growth contains both good growth and bad growth, versus NOA growth only contains growth that is financed by the shareholders bond market. So NOA growth will be more associated with future negative performance and stock returns comparing to the total asset growth. So that's the theory we have here. That's the theory you have here. Let's test it. Let's test it. Hopefully everything is clear here. Everything is clear here. Okay, so let's look at how we test it. How we test it. So let's look at the regressions here. Let's look at the regressions here. We use the NOA growth. Can you guys see my mouse? Good. Okay. We use the NOA growth to predict the future ROA. ROA is return on assets. It's like earnings, right? It's a fundamental performance. We use the total asset growth to predict the future ROA. We use the NOA growth to predict future returns. We use total asset to predict future returns. So let's look at ROA first. You can see that total assets growth predict the future performance. Good, in a good way. So basically, total asset growth can actually predict the future negative growth. There's a negative sign missing here. There's a negative sign. This should be a negative sign. It's missing. Just so you guys, there's a typo. Okay, the sign missing here. And then let's look at NOA growth. NOA growth can also predict the future negative earnings, but in a more stronger way. So you look at the coefficient. The NOA, everything is scaled. The TA growth and NOA growth, everything is scaled. So you can compare them directly. So basically, when you moving from the bottom decile to the top decile, the total asset growth can predict negative future earnings by 2 cents. The NOA growth moving from the negative bottom decile to the top decile can predict negative earnings for 4 cents. So you see the magnitude is different, right? Magnitude is different, and also t-stat is also different. That means this is consistent with my theory. Consistent with that NOA growth is more negatively correlated with future performance compared to the TA growth, total growth. And the reason is, like I explained before, because the NOA growth is purely financed by the investors, the bank loans, versus total asset growth has good growth and bad growth. The total asset growth has good component and bad component. So that's why the NOA growth can predict future negative return and sales in a more stronger way, with 4 cents and a higher t-stat, versus total asset growth 2 cents with smaller t-stat. So I hope that's clear for you guys. This is something you need to, that's the project you guys doing. You guys are doing it's a simple, right? It's an easy project. And you horse race the two variables together, and you find that only NOA growth loads, the TA growth do not load. That makes sense, right? Because the TA growth contains good growth and bad growth, versus NOA growth is only about the purely bad growth. So when you horse race the two variables together, only NOA growth loads, the TA growth do not load. So that means the NOA growth is the actual bad growth here, drives the negative returns. So that's for the future ROA. That's for the future ROA. I told you guys, whenever you test the market inefficiency, you have to do two steps. First, you have to test whether the variable predicts the future performance, sales. The second step is, do investor get it? Do investor actually understand this? So what I'm saying is investors. What I'm saying is NOA growth can predict the future. Take it back. What I'm saying here is NOA growth can predict future negative earnings. Is that some information only you know, or is the information everybody know? You have to test that. You have to test that, right? So you already show that the NOA growth can reduce 4 cents of earnings in the future. You show that. That's good. But is that 4 cents of earnings reduction, is that something you only know or everybody know it? So you have to test that in the future abnormal returns. So if everybody knows that information, the NOA growth should predict no returns in the future. Does it make sense? If everybody know NOA growth will depress 4 cents of earnings in the future, if everybody know that, you cannot, if you use NOA growth to predict the future stock returns, there will be no returns. Nothing will show up. Nothing will show up, because everyone will price the NOA growth in a very timely way. So when NOA growth can predict the future stock returns, only you know about the information. Other people do not know the information. So, and then in the next year, people gradually learn about NOA growth. Actually, it's a bad thing. It can depress future earnings. If if other people takes time to understand the information you know now, you can use the NOA growth to predict the future negative returns. That's the idea I explained in the first sessions. I don't know if that's clear for you guys. I know it sounds a little tricky, but this is fundamental for the market efficiency. Okay, let me just repeat it one more time in case some of you guys still confusing. For the future ROA test, we show that NOA growth can depress future earnings for 4 cents. That's the information we test. This is for sure. And then the second test we are doing is, are you the only person know that information, or everyone else know that? If everybody know that, when you use the NOA growth to predict the future stock price, you should see no returns, because the NOA growth is priced in an efficient way, in a timely way. However, if you know that information, other people takes 1 year to know that information, and then in the future year, you can get the returns from the NOA growth, because you buy and sell of the NOA growth ahead of other people. When other people do not know the information, you already buy. When other people do not know the information, you already sell. So because you know the information, other people can know a year later, so you can buy and sell ahead of other people. That's why you can realize the returns here. So that's why we always have a 2 test. You test the fundamental first. You use the signal to predict the future fundamental sales and earnings, and then you use that to predict the future stock price. If you don't see any results on the future stock returns, that means the information you tested in the ROA is already efficiently pricing. If the signal you can predict, the signal you use can predict future stock price, that means you are knowing something other people do not know at that time, and other people takes a little longer to understand the signal you produced from the balance sheet. So this is the test. You have to test it. Like I said, you cannot just you can just touch your head saying, okay, this is good theory, I like it, let's invest. This is you have to do the rigorous test to show that whether this kind of can generate a future profit for the investors. So let's look at these tables one more time. Okay, so the total asset growth predict the future negative return. Next, buy and hold 1 year. Okay, the abnormal return here is buy and hold 1 year. So annual return is about 9%. And then you buy and hold. If you use NOA growth, it's buy and hold 13%. It's about 13%. So what does that mean? This signal is consistent with the theory we talked about before. The NOA growth is purely bad growth that the managers doing empire building, financed by shareholders, bond banks. But the total asset growth is a combination of good growth and bad growth. So so you don't see much from it. You don't see much from it. That's why we have the NOA growth. We have the NOA growth we have the NOA growth from the equation. The NOA growth generate higher returns than negative returns than the total asset growth. And you horse race them together, you run them together, you find only NOA growth loads and the total asset growth do not load. Is that consistent with the ROA as well? We see, you know, ROA, only the NOA growth load and the total asset growth do not load. Same thing here. When you predict the future stock returns, we have the same pattern. So here we get the test. What does the test tell you? The test tell you that consistent with our prediction, NOA growth is the bad growth. When the growth is purely financed by the investors, bank loans and the bond market is bad growth. The total asset growth contains of good growth and bad growth. It kind of supports the argument. And we also can run this. We also can run this separately. You can see that you can run this separately to see that the returns are different from each other. You can see that when you control, because you have to control for other variables. When you control for other variables, you can see that the returns are also, one is stronger than the others. Yeah. So let's keep moving. Let's keep moving. Let's keep moving. So what's this for? What's this for? So this is methodology you have to learn as a finance major. You need to learn what is portfolio and the double sorting and the sorting. So so this is something you guys need to learn when you do the test. So let me explain the portfolio sorting and the double sorting to you guys. You see what's the idea behind. Okay, so what does this table mean? So what do I mean by you have to sort the whole stock? So each year in the US we have about 5,000 stocks. We have 5,000 stocks, and then what do? So you sort the stocks based on NOA growth. This is a quintile, and also you sort the stocks based on total asset growth. This is quintile sorting too. And then so each of the cell here represents all the stocks that's under the low NOA growth and the low total asset growth. So each cells here is the stocks fall into the category of the NOA growth and the total asset growth. So let's take an example here. So what does the stocks here mean? Stocks in this cell means stocks here have low total asset growth and a low NOA growth. That's the portfolio we have here. So what does the portfolio we have here? The portfolio we have here, that's the stocks which have high total asset growth, and also high NOA growth. Okay, that's the stock portfolio we have here. And we also have a portfolio here. What's the portfolio here? The portfolio here is the stocks, the group of stocks which has low total asset growth and also high NOA growth. Make sense? Let's look at here. What's the stocks? What's the number of stocks here? The group of stocks here is the stocks which has high total asset growth and low NOA growth. Okay, that's why we buy two-way 2x2 sorting. We buy 2x2 sorting. This is a very important test for you guys when you guys do the trading strategy. Why is that? Why is this important? The importance of this is because let's look at the rows. You guys can follow my mouse, right? When I move my mouse, you can see that. Okay, so let's look at the first row. Okay, first row. So when the total asset growth is low, when it's low, you can still see the variation on the NOA growth. So in that case, when you're holding the total asset growth constant, if you use a high NOA growth minus low NOA growth, you obtain very high future returns. Same thing, if you're holding the total asset growth constant, you use the high NOA growth minus low NOA growth, you obtain high returns, even if you hold NOA growth constant. Does that make sense to you? Okay, let's do the opposite. Let's holding the NOA growth constant. Let's look at this one. When you hold the NOA growth constant, you use the high total assets growth minus low total asset growth. Did you find any returns? You don't. Look at here. When you hold the NOA growth constant, you use the high total asset growth minus low total asset growth. Did you see any returns? You don't. So this 2x2 sorting kind of tell you who are the boss, right? So basically you can tell if we hold total asset growth constant, if you variate the NOA growth, you can get abnormal returns. But if you hold NOA growth constant, if you variate the total asset growth, you get nothing. So who is the boss here? Who is the boss here? Obvious. The NOA growth is the boss here because when you holding the total asset growth constant, the NOA growth works. When you hold the NOA growth constant, TA growth do not work. So the 2x2 sorting, it's a very typical way for you to tell who are the boss. It's the horse racing tool. Like you can tell who actually drives the results. So I want you guys to be able to do that. Okay, I want to do that. So by the way, when I give you guys the project I give you, I just want to explain. I already give you the variable total growth, NO growth. So I already give you all the variables. Because I feel like I don't want to. So actually, there's two steps to calculate these variables. First, you should use the original balance sheet variables to calculate total growth, and then use total asset growth to do the table. There should be two steps. I already give you the calculated total asset growth, NOA growth. So you kind of save you guys a lot of time. All you guys need just to do the regressions and do the sorting. You guys to yeah, that's the project I give to you guys. So basically if you want to do the original calculation, you have to use the original variables to get all this asset growth. So basically, like I told you guys, the balance sheet I show you guys has the 250 variables. So the first step is you use the 250 variables, some of them to calculate total asset growth, NOA growth, these all growth. So that's the first step. I just want to let you know I have done that for you. Okay, I've done that for you. So so you have all the variables ready, total asset growth and blah 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 ready in a data set I give to you. So all you need to do is to use the variables to run the regressions and to do the sortings, to understand the double sorting and stuff. But I know some of you guys are really good. Like last time, you guys have people who can do the PyTorch, TensorFlow. You guys, some of you guys can understand the regression very well. So if you are really want to more advanced project, I encourage you guys to do the calculation on your own, right? So basically, what I'm telling you is, for the class, I gave you the variable of total asset growth. I give you the net growth. I give you already the variables to you already. But if you want to construct on your own, it's up to you. Just do it as a practice. Okay, I will not grade it. I will not grade it. I will not give you extra bonus, blah blah. Just because some of you guys kind of impressed me in the class. If you guys want to do that, go ahead. Okay, go ahead. For the whole class, you have the TA growth variable, you have the NOA growth variable, you have that variable ready. So you just run the regression and do the sorting. But if you want to calculate the total asset growth, NOA growth, everything on your own from the scratch, from the original variables, do it. Yeah, I like it. Okay, I like it. So I just want to give you some ideas of what is going on here. And so let's look at this is double sorting. This is double sorting. And we also use that to predict the short-term window. Do you guys remember last sessions? I tell you guys why we want to do short-term window. Do you guys remember? The reason is because if you buy and hold for 1 year, there's a lot of risk. There's a lot of risk. You don't know the 10% of return is from the regret, is from the signal, or it's from the risk. But short-term window is 3 days. How many things can happen in 3 days? Relatively less, right? Relatively less. So if you can get the return from shorter window, that is good. That is good. That means you can really gain money from the trading strategy. That's why if you really want to recommend the trading strategy to your parents, do not just simply do the annual buy and hold. You have to do really regulars. You have to do buy and hold 1 year, to do 3 day, to do factor adjusted, to do portfolio sorting. After you've done everything, and tell everyone that's what I recommended. You know, you don't want to give reckless decisions to your friends or for your relatives, so you can do a more rigorous test. So here you can see that for the 3 day return, this is about 1%. This is about 1.8%. Do you know this is huge? This is huge. This is only 3 day return, buy and hold 3 day. And I take it back. Actually, it's not 3 day. So what we did is this is the 4 of 3 days. So it's the 12 days return. Okay, I take it back. This is 12 days return. So basically, we combine 4 3 days return together. So this is 1% from 12 days return. This is 1.8 from 12 days return. But this is huge. Think about it. You buy and hold for 12 days, and you get 1.8% after adjust for the risk. That's a huge. That's huge. So this is very confident. This is something, it's not risk driven. It's something there. This is something tradable. It's something tradable. That's the that's something tradable you have. So this is the trading strategy. Like I said, you cannot just do one simple regression. You have to do the buy and hold 1 year, 3 days, factor adjusted, portfolio sorting. So this is the factor adjusted. So what do you adjust a factor for? You do pharma French. This is the 3 factors, and this is 4 factors. So basically, this is double sorting. I explained double sorting, right? So in each portfolio, what do? You do the 3 factor adjustment. You take out the risk premium from the 3 factors, and this is the alpha. So each cell here is the alpha, and then you can see the alpha is significantly low. It's significantly low. This is something you need to do too. So you are not just doing you do a lot of risk adjusted. So this is a double sorting. Double sorting. I don't need to repeat double sorting one more time. So the only difference between here and over here is you do risk adjusted. This is a 3 factor adjusted alpha. Here is a 4 factor adjusted alpha. And how to do that? You can read the paper I give you guys. I think I give you guys detailed description how to do the risk adjusted alpha. How to do the risk adjusted alpha. And this is something you guys already learned from some of your classes. So the idea here is the strategy works for buy and hold 1 year. Works for 3-day short window. It works when you adjust for pharma French 3 factors. It works when you adjust for 4 factors. It works. So you think about all the ways that could affect the risk and the skills and the signals. Every single test, if it works, it gives you the confidence. That's something really working. That's something really working. So you have to do a very rigorous test to test this strategy. And I want you guys to be able to do this kind of stuff. And like I said, I already give you the NOA growth, ITL growth. So you the variables I have calculated for you. Yeah. Then okay, let me finish up, and I can open up to questions for you guys. I saw great questions. Let me finish up, and you guys can raise questions on what do we have here. What do we have here? So this is the strategy. This is a strategy we want to test. So basically, the steps here is first you have the theory first. You have the theory. You can talk to the industry people. You can observe the data pattern. You have a theory first, and then you test it. When you test it, you have different ways to test it to make sure this is really profitable trading strategy. This is a really profitable trading strategy, and this is what I want to talk about today. And I want to leave some time for the class for ask questions. Let me